All right. Welcome to the Tax Sherpa Stories podcast, video, LinkedIn, whatever, what have you. Last one of these I recorded was actually 2 years ago. And it's been, I don't know if you noticed, there was this whole thing called COVID that happened. And I got slammed really hard with COVID. But the last, what, 8, 9 months, we've been restructuring the whole business. And part of that is coming back and delivering information for people on these short video clips. So today is actually September 18th, and I wanted to go over K-1s for a minute. The pass-through companies, S corporations and partnerships, which are the most of them, those are originally due March 15th, and they get an automatic 6 months extension if you file for it, and that goes to September 15th, which was this past Friday. So a lot of people get K-1s, which is their owner share of the income or loss from those pass-through companies. They get them like March 14th or September 14th. Very few in between. And there's all kinds of reasons for that. We had one client that we were working on, his company owned pieces of other companies, and we were waiting on the K-1s from those to come in before we could file at his company. Things like that happen. But just by and large, middle March, middle September, people get a whole bunch of K-1s. And so what I wanted to talk about today was when you get a K-1, what does it mean and what should you do? Like I said, the K-1 is the statement of income and expense. In fact, let me bring up just a picture of one. Then generally there's two different kinds. There's a K-1 1120S, there's a K-1 1065. Let me share my screen here. So this is what they look like. There's a whole, so this is all the company information, this is the recipient information, and then there's all these boxes. It could be, depending on the form, there's slightly different versions, but basically the first chunk is all income or expense. So if the company made money, you'll have a positive number here. If you have the company lost money, you'll have negative numbers in here. Then these next parts down here, basically through about here, are different categories not used very much. There's tax credits, there's self-employment income if it's a partnership and you're active, there's foreign income, there's Section 179 deductions, which are not used as much as they used to be because we now have bonus, which is oftentimes better. And then at the end here, we've got distributions and other information. Other information is mostly to do with qualified business income deductions. When you get these things, the main things to look at is number positive or negative up at the top, and what do we have in distributions and other information. A lot of people get involved in syndications and other kinds of equity deals where they're a minority owner. So in those cases, you definitely, even if you only own 0.1%, you still have a right to get the full tax return. So make sure you do that. And the second thing is you want to pay attention to the distributions and capital accounts. So distributions is saying, hey, we paid out this much money to this person. And when you have the full return, you can see the full amount of distributions. So if you're in that minority position where you have no control over the thing because you're just a passive partner, then you want to make sure that one, the distributions to you are correct. Can't tell you how many times I have had clients come in, they bring in a K-1, and I say, oh, you got $8,000 of distributions. And then I ask, did you get that? And then they often look at me like, no, I didn't get any money. This says you did. You want to go back and talk to whoever's running this thing and make sure that those numbers are correct. And the other thing is that if you have the full tax return and you can see the distributions and capital accounts, you can see where the money's going, right? It's hopefully not, but I have seen cases where their active partners are taking all the money out, and maybe that's part of the agreement of how the whole thing was structured. Maybe it isn't, but you definitely want to know. And when you have the full tax return, you talk that over with your tax professional. They can go through all those things and figure out if things are on the up and up or not. So even if they are, there are potentially opportunities for revisions. One of the things that we've seen a lot of is cost segregation. So a lot of syndications go in, they buy some real estate. I had one client came in he brought in the original K-1, it said $3,000 loss. They brought in a month later, a second revised K-1 said minus $39,000 because they ended up doing a cost segregation study on the commercial property that they had. And what cost segregation does is that it shifts the depreciation from being spread out over the entire lifetime to being front loaded as much as possible. So it can have big swings in that initial year. And there's other, depending on the business, depending on the situation, there's other tax strategies that might apply to that particular business. And if those changes are made, then an amendment is sent, and then amended K-1s are sent out. When you get the K-1, look at the numbers, make sure they make sense, look at the distributions, look at the full tax returns, and review it with your tax professional. And that's our tip for today.